What happened in those 4 hours wasn't normal market behavior, and anyone telling you otherwise is either missing the bigger picture or hoping you do. Silver didn't just drift lower, it didn't gently correct, it didn't cool off after a long rally, it fell off a cliff, from triple-digit highs down more than 10% in a matter of hours, and it happened the moment political shockwaves hit the global system. That timing matters. Markets are supposed to price in data, earnings, supply and demand. What we witnessed instead was raw reaction. Fear, uncertainty, and instant repositioning triggered by power and policy colliding in real time. The moment tariff threats escalated, confidence vanished. Not gradually, not over days, instantly. Traders didn't wait to see how negotiations would unfold. Algorithms didn't pause to analyze long-term implications. The sell buttons were hit all at once, and silver became the first thing to be sacrificed. Why? Because in times of sudden political risk, silver isn't treated like a precious metal. It's treated like liquidity. It's something large players can dump fast, in size, without explanation, to raise cash and reduce exposure. And that's the part most people miss. This wasn't about whether silver was overvalued. It wasn't about mining output or industrial demand. Nothing fundamental changed in 4 hours. What changed was the perception of risk. When politics injects uncertainty into global trade, markets don't wait for clarity, they run for the exits. Silver just happened to be standing closest to the door. You could almost feel the shift as it happened. One moment the market was calm, confident, even optimistic. The next, everything flipped. Bid walls disappeared, support levels that looked solid minutes earlier were sliced through like they weren't even there. Stop losses cascaded, margin calls followed, and once momentum turned negative, it fed on itself. Fear always moves faster than logic. This is where the illusion of safe havens breaks down. People like to believe that silver exists outside the system, that it's insulated from politics and power struggles. But when the stakes rise suddenly, when governments threaten tariffs that can choke global supply chains, silver becomes part of the system again. It gets dragged back into the same machinery as stocks, bonds, and currencies. In that moment, it stops being protection and starts being collateral. And let's be honest, this kind of move doesn't come from retail investors. Small holders don't cause a 10+% collapse in hours. This was institutional money moving fast, protecting itself before the broader public could even process what was happening. The reaction tells you everything you need to know about who's really in control. The big players saw risk and moved instantly. Everyone else was left staring at the chart asking what just happened. What's even more alarming is how predictable this pattern has become. A political statement drops, a tariff threat surfaces, a diplomatic shock hits the wires. And markets react before facts are confirmed, before policies are signed, before outcomes are clear. We're no longer in a world where markets wait. We're in a world where they assume the worst first and ask questions later. That's why this silver crash matters far beyond the price itself. It shows how fragile market confidence has become. It reveals how quickly narratives can change. Just hours earlier, silver was being talked about as a breakout, a hedge, a long-term play. 4 hours later, it was treated like dead weight. Same asset, same fundamentals, completely different story. And once that kind of volatility enters the picture, it doesn't just disappear. Damage lingers, trust erodes, traders become jumpy. Every headline starts to feel like a potential trigger. That's how instability spreads. Not slowly, but in sharp bursts that reset expectations overnight. This is also a warning about how intertwined politics and markets have become. You can't separate them anymore. Decisions made in press conferences now move trillions of dollars in minutes. Tariff threats don't just affect exporters and importers, they ripple through commodities, currencies, and entire financial ecosystems. Silver didn't crash in isolation. It reacted as part of a much larger system suddenly questioning what comes next. And here's the uncomfortable truth. When markets react this violently to words instead of actions, it means confidence is already thin. It means participants were looking for an excuse to de-risk. The political shock didn't create the weakness, it exposed it. Silver was simply the pressure point where that fear finally broke through. So when you look back at this moment, don't just remember the numbers on the screen. Remember what they represent, a market that can erase massive value in hours based on political tension. Alone is a market sending a message. It's saying stability is fragile. It's saying control is concentrated. And it's saying that when power shifts, prices will follow fast. What really poured fuel on this fire was what happened next. And it didn't come from traders staring at charts. It came from corporate boardrooms scrambling to survive. As tariff pressure tightened around South Korea, the problem stopped being theoretical and became immediate. When tariffs threaten to choke exports, companies don't have the luxury of waiting. They don't debate narratives or hope markets calm down. They move, and they move fast, because cash flow becomes king overnight. Think about what tariffs actually do. They don't just raise prices. They disrupt supply chains, compress margins, and force companies to absorb costs they never planned for. For export-driven economies, that pressure hits all at once. Orders get delayed, buyers hesitate, forecasts get slashed, and suddenly, even the biggest corporations are staring at a liquidity problem they didn't see coming weeks earlier. That's when emergency decisions happen. Not strategic, long-term planning, emergency positioning. Balance sheets are reviewed in real time, non-core assets are identified, anything liquid enough to convert to cash quickly becomes fair game. And silver, despite all the stories people tell about it being untouchable, sits right there on the list. When massive manufacturers face sudden tariff exposure, they don't sell factories or lay off workers first. They sell what they can sell immediately: metals, reserves, financial instruments, anything that can be converted to cash without negotiations. That's how silver gets ragged into the storm. Not because its value disappeared, but because it was useful in a crisis. This is the part most retail investors never see. Corporate liquidation doesn't announce itself with headlines and explanations. It happens quietly through large orders that hit the market when liquidity is thin. One sale becomes another. Dealers adjust prices. Market makers step back. And suddenly, what looks like a mysterious collapse is actually a chain reaction driven by survival, not speculation. And once that selling begins, it feeds the larger panic. Traders don't ask why the metal is being sold. They just see that it is. Price breaks trigger more selling. Funds rebalance. Leverage unwinds. The original reason almost stops mattering because momentum takes over. What started as corporate risk management turns into a full-blown market event. This is why the timing was so critical. The tariff pressure didn't hit after weeks of preparation. It landed suddenly when markets were already stretched and confidence was thin. Corporations were forced to act under stress, and stress decisions ripple outward. When giants move, the market feels it instantly. There's also a psychological layer here that can't be ignored. When people hear that major industrial players are liquidating, it changes perception. Silver stops being viewed as a long-term asset and starts being seen as a distress tool. That shift alone can crush sentiment. Nobody wants to hold what others are dumping to stay afloat. And let's be clear, this wasn't about one company or one country acting alone. This was systemic pressure. Tariffs don't isolate damage, they spread it. Suppliers feel it, partners feel it, competitors feel it. The moment one major player starts unloading assets, others prepare to do the same just in case. That anticipation becomes its own catalyst. This is how markets break faster than logic would suggest. Everyone is acting defensively, not because they want to, but because they have to. And in that environment, silver becomes a casualty of global stress rather than a reflection of its true value. What makes this especially dangerous is how invisible it is to the average person. From the outside, all anyone sees is a price collapse. Inside the system, it's a cash scramble. It's treasury departments calling emergency meetings. It's risk managers demanding immediate exposure reductions. It's decisions being made in hours that normally take months. And once that dam breaks, there's no easy way to stop it. You can't undo liquidation with reassurances. You can't talk markets back up once forced selling takes hold. By the time explanations reach the public, the damage is already done. This is why the silver crash can't be dismissed as random volatility. It was a stress test, and the system showed its cracks. It revealed how quickly industrial pressure turns into financial pressure and how fast financial pressure spills into commodity markets. Silver didn't fall because it failed. It fell because it was usable. And that should make everyone pause. If a globally recognized store of value can be treated like an emergency ATM during geopolitical strain, then the risk landscape has fundamentally changed. Assets are no longer just investments, they're contingency plans. What we witnessed wasn't weakness in silver, it was desperation elsewhere, showing up in the one place it could move instantly: